Hello, everyone. It is a pleasure to be connected with you today. Thank you for being a part of this GEF-supported project on the Global Biodiversity Framework Early Action Support. And welcome to this 11th webinar in our series of capacity building webinars. The topic of this webinar is Nature Bonds, Catalyzing Investments for Biodiversity. This webinar today is aimed at supporting CBT parties and other stakeholders to understand the possible applications of public and private finance to their NBSAP revisions, updates, and implementations. My name is Gaurav Gupta, Nature Investment Advisor at UNDP Biofin. This webinar is delivered jointly by UNDP Biofin and UNEP-FI. Nature bonds have emerged as crucial financing instruments, reflecting the growing recognition of the importance of investing in biodiversity and ecosystem services. Their relevance has surged as governments and investors seek innovative solutions for biodiversity conservation, with green bond issuance, for instance, reaching a record 630 billion in 2021. However, we also understand that only a small portion of those proceeds from green bonds, for example, are invested into biodiversity. In the webinar today, we will hear from the leading industry experts on innovations being designed and deployed to unlock more financing for nature through fixed income instruments such as bonds. I'm sure you are all experts on Zoom by now, but let me just cover the most important logistical details. Simultaneous interpretations are available in French, Spanish, and Russian. Thank you, Denise, Jose, and David, our interpreters, for being with us today. To activate interpretation, you can click on the word icon at the bottom of your screen and choose your preferred language. I would suggest that you choose one channel and stay on it for the duration of the webinar to avoid any technical glitches. And I would also like to recommend both speakers and participants to speak slowly. This facilitates the interpreter's job and flow in the conversation. If you have technical issues, please send a private message. Do not send a message to everyone in the chat. Just send a private message to my colleague, Martina Ashanis. Your microphone will be muted to help ensure our speakers can be heard clearly. We encourage your participation. To ask questions, you have two options. The preferred option is that you type your question in the chat and you don't need to wait until the end to ask your questions. You can ask the questions as and when you have them. And we will go through the questions in the order that are being in the order they are asked. The second option is that you, towards the end of the session, you raise your hand. If you have time, we will invite you to ask questions. And finally, we have a webinar webpage where we and you all can access today's presentation and recording. We will also share them by email after this series concludes. Also, to access the past webinar sessions, you can navigate the NBSAP forum webpage. Again, my colleague Martina is dropping the link in the chat. So let's start. Here is today's agenda. We have 4 presenters and panelists. I will introduce them as I invite them to speak. At the end of the presentation and panel discussion, we will have an open discussion where you can ask questions and share your thoughts. So first, I would like to invite Slav Kachev, Managing Director, Sustainable Debt at the Nature Conservancy. Slav leads TNC's Sustainable Debt team, which deploys nature bond transactions to mobilize capital for marine, terrestrial, and climate projects in emerging markets. Before joining TNC, Slav was a managing director at DEFOS, a boutique investment bank, where he raised over 3 billion for project financing in emerging markets. Slav, the floor is yours.
Thank you very much. Thank you very much to you, Gaurav, and to all the organizers. I'm super happy to be here and really appreciate the keen interest in the topic. I'll walk you through a few slides, and then hopefully we'll have the opportunity for more of an interactive Q&A. So it's interesting that the topic of this webinar is nature bonds. We're in a way flattered because TNC's internal code name for our capital markets oriented program for nature, for biodiversity and climate-based solutions is actually called Nature Bonds. It came as a result and is following up on our successful Blue Bonds program for ocean conservation. And we figured that we don't want to necessarily limit ourselves to the ocean only, as of course terrestrial areas, think grasslands and tropical forests need a lot of love as well, and attention. And there is as all of you are keenly aware, there is a tremendous biodiversity funding gap that needs to be tackled. That funding gap, depending on estimates, ours is 700 billion funding gap. On top of that, there's probably a 1 trillion funding gap for climate, just for the global south. These funding shortfalls are made worse by the debt crisis that many in the global south are experiencing. A lot of sovereigns that have placed euro bonds in the past, for example, are paying dearly to return to the international capital markets to refinance their obligations. The high yield segment of the emerging market bond index has a spread of 10 percentage points over US treasuries. So on average, sovereigns such as Kenya and others are paying to the tune of 11, 12, 13, even more percent to access capital markets. And of course, that makes it even more difficult for them to fund their own nature. And so we decided to do something about that by coming up with structures that refinance pre-existing commercial debt, and then they deploy, the structures deploy the savings through an independent conservation fund towards biodiversity programs in our partner countries. And so, this program is a very powerful tool that goes to the heart of the problem. It takes what is problematic and uses capital markets to actually cure, if you will, capital market sins and deficiencies. The program, of course, was inspired by the earlier debt for nature swaps, which were done starting in the 1980s and into the 90s under various programs, including in the US, a piece of legislation known as the Tropical Forest, and then they added Coral Conservation Act, which authorized US Treasury to offer bilateral deals to sovereigns. So think, for example, US and Bolivia in the late 80s, where our friends from Conservation International tackled $600,000 of debt, generating savings of $100,000. Now, these numbers are, back in the day were rather small. And we figured that if we use the technology, right, of the debt for nature swaps, including the insight that there is debt out there that is not going to be repaid on time, that is unsustainable, and if that debt can somehow be tackled, then that can generate important savings that then would flow through a conservation fund, would add the conservation advisory assistance by international NGOs such as the Nature Conservancy, the largest of them all, and then our friends from WWF and Conservation International, Wildlife Conservation Society, and others. Then you have a powerful package that would work for our partner governments to implement what they want to do, to implement national strategies. And so the difference from the earlier transactions, again, is the focus on commercial debt. And the benefit of that is that you're less dependent on the political cycle and political winds that can blow in different directions. So I mentioned Bolivia, and guess what? In today's environment, the US wouldn't offer a bilateral deal to Bolivia because of political tensions, say, between the two countries. Whereas when you're dealing with commercial debt, you have the profit motive, and you can do an arm's length transaction where you pick up discount that already exists in the market. And so long as you can organize then the new financing such that it can be provided at much lower rates than the pre-existing financing, then you generate these savings. And this somewhat wordy slide describes, I'm not going to repeat what the slide says, so hopefully you have a chance to sort of skim it as I'm covering related topics, but these slides presents the key stages, if you will, of a nature bonds project, and I can describe that in more detail during the Q&A. And so, what have we accomplished then to date with this program? Going back to starting on our blue bonds strategy. Well, in the last 3 years, we did 3 of the major commercial transactions, commercial debt conversions, including the pioneering one in Belize that we did, November 3 years ago, November of 21. And together, those, when you add the Seychelles, which was a bridging transaction that we did 5 or 6 years ago, together these transactions have unlocked $400 million for nature. And the $400 million, the key to understand there is that it was provided at no additional burden to national treasuries. In other words, by refinancing more than $1 billion of commercial debt, principally Eurobonds, we generated these important savings, which will accrue to these countries over the next 15 to 20 years. And then even more importantly, beyond the dollars and cents, these ocean-oriented transactions help protect the area, the size of the Gulf of Mexico, and we're already seeing important results from some of the earlier transactions like the Seychelles in terms of the country's commitment to protecting 30% of its ocean, actually doing so, and already seeing some biodiversity benefits. In addition to what we did, our friends from Pew did an even larger transaction for Ecuador following similar principles. They refinanced 1.6 billion nominal of debt with a 650 million of new line, generating $400 million of savings. And so then together, when you add the Pew transaction, you see the scale that can be generated by deploying capital markets instruments. And so this slide, again, pretty wordy, but you will have access to these presentations for future reference. And by the way, we have detailed case studies on Seychelles, Belize, and Barbados available on our website. And we're going to release soon one on Gabon. So this slide presents some of the key terms and conditions of each of the projects that we did to date, and show you, the slide also shows you the diversity of applications. So those of you who follow, capital markets would know that Belize was in a very different financial situation than, say, Barbados and Gabon, meaning much worse. Their Eurobonds were trading at very deep discounts, whereas in Barbados and Gabon, they were close to par. And yet these structures, when deployed correctly, can generate savings and make a difference in a wide range of pre-existing financial situations. The key, again, is to be able to deploy new funding to refinance the old, where the new funding has to be done at a much lower cost than what the country can achieve in the capital markets alone. And we do that by surgically deploying risk mitigation instruments, principally but not exclusively from multilateral development banks and DFIs. So, for example, we use DFC, which is the US bilateral development agency. We use their political risk insurance product. We have also used partial guarantees from the Inter-American Development Bank. And we're now working on another transaction in the Caribbean, which will have a mixture of multilateral partial guarantees alongside with private insurance and a private guarantee provided by a philanthropist / impact investor. So there is definitely room for continuing innovation to keep generating these important savings that would then help protect nature, be in line with NBSAPs, and also be in line with the Convention of Biological Diversity in terms of durable and equitable protection 30% of the Earth's surface. And so I'm going to quickly go through a couple of slides to illustrate what we have done in Belize post-financial close. It is completely fine to celebrate financial close, but then the real action on the ground happens after close in terms of deploying the funding and then working towards these important biodiversity benefits. And so in Belize now, which again closed just under 3 years ago, things are going really well. The government has made all the payments due to date, including the conservation funding that has flown into an independent conservation fund. The conservation funding payments by the government over time, which represent a portion of the savings from the transaction, have then helped the Independent Conservation Fund, which was established, to make important payments, important funding flows to NGOs, local communities, and indeed to government agencies to be able to implement an inclusive participatory marine spatial plan and to enforce and meaningfully protect already declared marine protected areas. And so the continuation of the marine spatial plan, known locally as the Belize Sustainable Ocean Plan, is now underway by basically making aware community members of the fishing and other communities that use the ocean of the plan to protect 30% of Belize's ocean and soliciting people's feedback as to their economic activities on the ocean, where they fish, what pressures they see on this very valuable, really strategic commodity for the nation when you think about fishing and tourism in Belize. So this takes me to the end of my presentation. Thank you so much for your interest, and I look forward to discussing these topics in the chat and with the moderator and with all of you. Thanks again.
Many thanks, Love. And the work that TNC has been doing has inspired many people to look at new innovations for financing nature. So many thanks, Love. So let's continue with the presentation. And it is my pleasure to invite Mr. Nonde Sichilima, Director of Market Supervision and Development, Securities and Exchange Commission of Zambia. Mr. Nonde has over 19 years of experience in capital markets regulation and supervision, financial accounting, and financial and operational auditing. He has been with SEC Zambia, Securities and Exchange Commission Zambia, for the last 8 years in the Market Supervision Unit, which is responsible for licensing and supervision of capital markets operations. Mr. Nonde, the floor is yours.
Thanks, Gaurav, and good afternoon to all the participants. Thank you for attending this webinar today. I'll just share a couple of slides. So really for me, my job is to try and bring you into our world in terms of what our journey has been like to create an enabling environment for green finance, and particularly for the green bonds, which was our chosen instrument for this purpose. That just covers some of the things I'll talk about, just to provide context, where we were, what our journey has been like, and then I'll eventually end up just discussing some of the challenges that we seek to address on a daily basis, just to make sure that we are winning this. We are contributing to climate finance. So really, sometime in 2017-18, I think we began to realize that Zambia really is not spared from the effects of climate change like everyone else. And we've really been able to see that if you look at some of the statistics, economic data around the country that we have, For example, we had a 50% drop in economic development. And for those of you who are familiar with Zambia in Central and Southern Africa, you'll be aware that we're actually grappling with the effects of a severe drought, which has culminated into a power deficit in the country. So we literally have sometimes up to 20 hours of load shedding. And that has a downstream effect in terms of the economy. Business are also struggling with that power challenge. And I think it's a good time to talk climate change, because now people can see the effects in reality, rather than people thinking that it's just a theory that the scientists have come up with. So that's the scene that we are seated with as a country, having to address the funding gap. Right now, it's estimated at 17.2 billion, but my own assessment is it's probably much higher than that. In terms of our long-term strategy as a commission, we are seated with what we are calling the Capital Markets Master Plan. So a lot of the initiatives that we have around green finance are actually anchored on this 10-year strategy up to 2031. And the whole idea behind this is, as capital markets, we need to make our rightful contribution, but at the same time, making sure that we are not forgetting the environment, just to learn from the mistakes that the mistakes of the past. So somewhere in 2018, people actually approached us, market players wanted to issue a green bond. And one of the challenges that they had was there was no regulatory framework for them to issue a green bond. So if you looked at our current regulatory framework, it's quite broad. It allows us to quickly come up with guidelines or regulatory frameworks for any new product that people out there want to bring to our capital markets. So using that same framework, we began to develop what we are calling the Green Bonds Guidelines. And this was a response to the industry demand that there was nothing for them to anchor their product on. So investors were continually asking, but what's the framework? And so in 2019, we partnered with Biofin, who helped us do a series of workshops, and also helped us to draft the Green Bond Guidelines. And these were actually issued in 2019. And they actually formed the basis of the Green Bond that I'll speak to later on. This slide just speaks to the salient features of our guidelines. And the core issue for us with green bonds is we just focus on the use of proceeds. So it can be your vanilla bond, except if you call it a green bond, then applying the principle of what's the use of proceeds that you've told your investors, then it has to meet certain standards that certify it as green. So a lot of emphasis in our framework is on the disclosures that the issuer or the person seeking to issue the green bond is making. And hence why you see that there's also the need for an independent external reviewer to provide that additional assurance to would-be investors. That's just some of the categories in terms of the eligible projects for green bonds. So I won't really go into this. I believe the slides will be shared. Please feel free to review this, and indeed on our website, you should be able to access our green bond guideline. I did talk to our country strategy and vision, which was to make Zambia a global green investment hub. And this slide really just shows how we thought to bring in all the stakeholders in the country to make this a reality as we green the economy. I also thought it would be good to share with you an initiative that we have in Zambia, which is what we are calling the Green Finance Mainstreaming Working Group. And the whole idea behind this is we have 3 financial sector regulators in Zambia. The Securities and Exchange Commission, which is the agency that I work for, the Central Bank, which is the Bank of Zambia, and the Pensions and Insurance Authority. And what we noticed was that each one of us were working in silos in terms of sustainable finance and green finance. So they were riding on an existing arrangement, tripartite agreement. The Green Finance Mainstreaming Working Group was formed just to make sure that all three financial sector regulators are speaking the same language, even as we develop guidelines and regulations in our own spheres of influence, as it were. So this was actually one of the main drivers of the green finance, the green bond guidelines. And subsequently, we've also gone on to issue what are known as the green loans guidelines by the central bank. All those were actually pioneered by the Green Finance Mainstreaming Working Group. That's just a slide that shows the other stakeholders or members of the Green Finance Mainstreaming Working Group. So you've got your UNDP Biofin, WWF Zambia. We've also got two key ministries that deal with the environment in Zambia, which is the Ministry of Finance and National Planning and the Ministry of Green Economy. Suffice to say that in terms of some of the biggest three projects that we are driving as a Green Finance Mainstreaming Working Groups is to do with the green bond market development. And then we're also developing a green finance strategy and implementation plan and the green finance tagging and reporting system. I won't delve too much into this, but just to highlight some of the big projects that we are undertaking as a working group. So one of the biggest achievements that we've had, other than the issuance of the two green bond guidelines and the green loans guidelines, is the lobbying that we do as a mainstreaming working group for tax incentives in order to support green finance. So we were able to get 15% withholding tax exemption on green bonds income in the hands of the investor. And on the part of the fees, we were also able to get some fee exemptions for the registration fees for green bonds. In terms of lobbying, our work is ongoing. So it's something that we do almost on a daily basis. As early as last week, our team were actually making representations to the Ministry of Finance for the 2025 budget submissions. And we are hoping to see a lot more, some incentives towards them to support green finance and incentivize issuers who want to come and issue green bonds. Okay. So we did have another key achievement, which was the registration of a $200 million bond by the Copperbelt Energy Company, which is a local energy company in Zambia. And they subsequently issued 54 million of that registered bond in January of this year. And just last month, they actually proved that the green bond is working for them by paying a 2.4 million coupon. So it goes to show investors that this is not philanthropy. It's real issues, energy being generated, and this company being able to meet its continuing obligations whilst they're operating a 60 megawatt power solar plant within the Republic. I did speak to some of the activities that we're undertaking as a Green Finance Mainstreaming Working Group. I won't go too much into this, just to say that some of these are ongoing. A big one for us is the Municipal Bonds Project, because it really targets our local authorities in Zambia to help them develop a framework for raising finance through green bonds. And it's quite passionate for us because we live in these municipalities and would be happy to see our local authorities access capital markets by issuing these green bonds. So in terms of the way forward, I did speak to the lobbying work that we continue to do under the Green Finance Mainstreaming Working Group. That's ongoing. We lobby with whichever stakeholder that we meet with. We want to develop a sustainable finance roadmap. As you may be aware, as a jurisdiction, we adopted the IFRS S1 and S2, the Sustainable Reporting Standards, So we want to develop a roadmap for the country to get to be able to report under those standards. We'll continue with our policy work in terms of ensuring that the regulatory frameworks, the policy changes that we need are implemented, especially as we continue to implement the capital markets master plan, which is the overarching document that we are using for these things. I thought I end this afternoon presentation by also saying that one of the biggest challenges that we are also having in Zambia is a lot of us that are talking about green finance, saving the earth, and all these doing things sustainably are not actually walking the talk. So one of the things that we have sought to do as the Commission is to begin to show members of the public and all our stakeholders that we mean business, we practice what we preach, and we have begun to take steps to show that we are also beginning to transition away from practices that are harmful to the environment. So the first step was to establish a green and sustainable finance unit within the Commission. And this one is dedicated to ensuring that we as a Commission, in whatever we do, we are focusing on green and sustainable finance issues. We've also looked at our energy. We currently run on a backup diesel generator, which we said is not good for the environment. So we've actually set up a mini solar plant on our rooftop, which generates about 18 kilowatts of electricity, but it does power a lot of the things within our building, and that takes away the need for us to use the generator, the genset for backup. So during the day, we are almost 100% on solar. We're also working with our partners, WWF Zambia, to embark on a tree planting exercise. There's been hectares and hectares of land that's been identified within the country, and our plan is to participate in that. And also, because we are a capital markets regulator that's really focused on disclosure, the idea is not just to plant these trees and leave them there, but to actually show how is that exercise actually contributing to the climate fight. So we are hoping to be able to generate some statistics. For example, what's the carbon offset of our tree planting exercise versus our own carbon footprint in terms of our activities as a commission. So that's just two initiatives for a start, and we hope in future presentations we'll be able to speak more to this. So that's been our journey, colleagues, in terms of our sustainable finance journey. The green bond really is our primary instrument in terms of what is the best way we can have people participate in capital markets using this instrument. So the kind of regulation, like I said, that we have is we are market driven. So if somebody walked into our jurisdiction and said they wanted to come up, for example, with a blue bond or something like that, our regulation using the various provisions of our law allows us to quickly come up with a framework and that is suitable for whatever demand. And the green bond guidelines were actually an eye-opener for us in terms of how quickly we were able to respond to the market need, and subsequently to actually see an issuance of a green bond, which everybody, starting from the Republican president, was able to visit and praise the capital markets for facilitating that. Was actually quite a big win for us, and it encourages us in terms of our everyday work in this space. Thank you very much.
Thank you, Mr. Nonde. This was very inspiring, and I'm sure a lot of countries we have many participants from different countries, and there's quite a lot of interest from learning about the journey that Zambia took in this process. If I could ask my colleagues to stop sharing the slide.
Okay. Can
Mr.
stop.
Nonde, could you? Yeah, perfect.
Yeah.
Thanks.
Thank you.
So moving forward, I would like to invite Ms. Tanka Zoltani, Senior Advisor, Development Finance and Thematic Debt at UNDP, and also founder of Better Finance. Tanka leads UNDP's debt service offering, where she is responsible for the global portfolio. Tanka is also the founder of Better Finance, a boutique advisory business working at the nexus of impact and ESG. She holds several board positions and is an internationally recognized speaker on the topic of impact investing. Tanka, please.
Thank you very much, and thank you, colleagues, for today and the inspiring presentation from the gentleman from Zambia. Indeed, I think the slides that I will present build on what our two previous speakers said. Certainly the insights from TNC have helped to shape the market, and now the innovations coming out of Zambia and elsewhere are really bringing innovative bond structures and opportunities to the emerging markets and to the developing world. I'll spend about 10 minutes talking about the role of nature in thematic bonds and the potential impact on the global economy. I will try to leave it at a higher level, but hoping that you can reach out after the presentation in case there are questions or certainly opportunities to engage with entities like UNDP, Biofin, and others that are helping to shape this space right now. So to give a high level, so let's take that 30,000 or however many feet view it is, the role of nature in thematic bonds is growing, but it's not yet well defined. So we certainly see the headlines from the exciting innovations on debt for nature swaps, nature bonds, et cetera. But in fact, it's been a really small part of the market to date. We expect that this growth of the sustainability-linked bond market is going to change the landscape and regulatory drivers, plus for platforms like the TNFD. So I'll talk a little bit about that. To give again an overview in terms of what we're talking about when I refer to the sustainable bond market. So UNDP supports transactions in the thematic bond market, so those types of bonds that are really linked to delivering the SDGs. And if we look broadly, so there's a subset of these sustainable bonds, whether it's green, sustainability, social transition, so helping entities transition, and sustainability linked. And if you look at this very nice diagram, of course, we see a rapid growth. There has been a very, very long and strong history, I would say, from the corporate market, and then more and more coming from the sovereign market, especially in the developed countries, but increasingly in the emerging markets. And this is where nature has a very, very strong role to play. So if we look at biodiversity as an investment in the green market, indeed, it hasn't yet become mainstream, despite, I think, what we're hearing and all of the positive attention. In fact, it's only been 8% of the total raised in the market directly funding nature protection efforts, compared with over 50% in renewable energy infrastructure. And if we take a step away from renewable energy and broader infrastructure, it's even more. So it's just been easier, frankly, to deploy capital into green opportunities without specifically homing in on nature. If we look at sales of bonds that are mentioning biodiversity in their frameworks, it reached a record high of 165 billion. This was the end of August 2023. I think that figure reached about 200 billion in the end. We don't have the most recently reported number yet, but we know that it's been a significant growth. So it's a 77% jump from the about 100 billion raised in the same period last year. So again, the message that I'm going to be sending today is that the theme, the demand, the appetite is there. It's a growing market, but we need to get it right for nature. Bonds incorporating biodiversity loss prevention and nature protection objectives are on the rise. So we'll talk about the key performance indicators in a second and why this market has some challenges, but we know that they now account for almost a third of total of these ESG labeled debt issuances so far, up from 3% in 2015 when the market was really at its early days. So now we're expecting the annual issuances to come closer to 300 billion by the end of 2024. Pictet has done an interesting analysis. This is one of the Swiss banks, drawing from sources like IIF and others, to finally put a figure on how much biodiversity and nature is being incorporated into debt. It's been notoriously difficult to pin down. I think with Gaurav, we'll talk about some of the challenges around data and tracking this accurately, but we know the trend is certainly on the rise, and it's a market that it's expected to continue accelerating. Indeed, what I just said, well, Sustainable Fitch has reiterated this. We expect nature to become increasingly mainstream within ESG as the universe of investable assets growing. This is indeed a subset of green and sustainability labeled bonds, part of their features. And the reason that this is very important is because they have done an outreach to the institutional investors, to the large buyers of these bonds, who are in fact demanding this type of instrument. As I just mentioned from Sustainable Fitch, it's also Citibank, who's a longstanding partner of UNDP, amongst other banks. They did a sustainable investment survey, which found that actually more than half of investors who had responded are either making some progress in integrating biodiversity loss into the investment analysis or planning to do so. When we talk about TNFD in the panel, the reason, again, that this is important is because the first step is to identify what biodiversity and nature-based metrics are material to these financial institutions, to these investors. And once that is tracked, then it's easier to devise debt instruments or other financial investments that can incorporate nature and certainly biodiversity to influence that materiality. Being nature positive is again one of these trends that is not expected to go away. New frameworks are being developed. UNDP is working on quite a few of these. So again, the gentleman from Zambia talked about the importance of having a robust framework or really a robust offering around what potential debt or other instruments are going to be doing. And this is one of the centerpieces of UNDP's work on this. EU regulation, it's not only important for the EU. So the EU Council has adopted this nature restoration law just this month, or I guess just last month, the goal being to support ecosystem recovery, nature recovery. It was cast pretty widely, but it's going to have global repercussions. So certainly member states are going to be thinking about their own biodiversity strategies, but I think this is going to have an influencing effect onto global markets, emerging markets as well, I think around the world, which could lead to an increase in green and sustainability bonds.
Apology to interrupt. Could you speak slightly slower? I just received a feedback from the interpreters.
Yes, apologies. It's because I have spent time in New York, everything is accelerated. Apologies for that. So to reiterate on the EU regulation, the reason that this regulation is expected to have a momentous and longstanding effect is because the influence it's going to have on EU member states to enact investments and certainly project financing to improve the recovery of nature at home in the EU's backyard, so to speak. But it's likely to push an increase in green and sustainability bonds from these sovereigns, which will influence what others are doing in developing markets or markets outside of the EU, how these bonds are structured, what the key performance indicators are, if any, and what is the use of proceeds. So if the EU can successfully devise instruments where the bonds are using nature-based cash flows to repay, then that will have a really exciting halo effect and certainly an effect in other markets. Maybe just one or two more slides because I know we have a deep panel discussion coming on. The two types of bonds when we're talking about how biodiversity and nature can be included is use of proceeds and sustainability linked bonds. So the use of proceeds bonds are what we are probably more familiar with. They're dedicated to environmental and or social benefits. The proceeds, we can talk about how they're managed, but ultimately these have a pretty wide net when it comes to what and how can be used for repayment. But those are generally earmarked or segregated into portfolios that are tracked by the issuer and then attested to in the monitoring and reporting ex post. The rise of the sustainability-linked bond is really exciting for nature because they include a mechanism by which using the interest rate or the coupons, these change depending on the issuer's ability to meet specific goals. So a sustainability-linked bond will include key performance indicators, perhaps tied to nature directly, which influences actually the repayment of that instrument or the repayment to the investors, how much the investors will get if these targets are met or not met. And the SLBs in particular have been rising. 2024, we'll see what happens because there is an emergence of these instruments at the sovereign level where traditionally they have been dominated by corporates. But again, because of the exciting opportunity to integrate really meaningful key performance indicators, some have picked up the SLB as an instrument to send a signal to the market about their intentions around climate and diversity have been the most popular, but nature is on the rise. I'll stop here. I just want to say that looking ahead into both the sovereign and the corporate market, there's a very strong opportunity, according to the European Commission and the EIB, to issue SLBs tied to nature projects, because they can, if they can prove steady cash flows, they don't have to exclusively rely on nature-based solutions to pay back the interest and principal, but they can mix and match the uses of proceeds, so to speak, to allow for a growth of nature-based projects alongside other, hopefully green, sustainable uses of proceeds that can then be monitored and rigorously reported to investors so they understand where the money has been spent and why, and what that repayment profile is. So let me stop here rather than doing a case study, and thank you for attention. Looking forward to getting into the details on the panel.
Thank you very much, Danke, for an incredibly insightful presentation. So let's move to the next section of the webinar, which is the panel discussion. We are running slightly late, so we'll keep the panel discussion to about 15 minutes, and then we will move on to the audience Q&A. So let me first invite Chris Smith. Chris is the Managing Director and Global Head of Sovereign Sustainable Finance at Bankers Without Boundaries, BWB. Chris has decades of experience across a range of corporate, global markets, and institutional banking roles, such as he was the Global Head of Sustainable Finance at Standard Chartered. I don't want to list all the positions that Chris held, otherwise it'll take me an hour. So Chris, BWB is an organization that everyone is not perhaps so familiar about. I see that my camera has frozen. Sorry about that. So BWB is not an organization that everyone is very familiar about. So if you could just very briefly explain what BWB does, and also share some of the really top-notch innovative financing instruments that you have been working on beyond the traditional thematic debt. Over to you, Chris.
Thanks, Gaurav. I hope you don't have to list that many jobs, otherwise that makes me feel incredibly old. But I'm with you. Wisdom, let's call it. Interestingly, where BWB came from, Bankers Without Boundaries, I think plays to the very heart of the nature financing and biodiversity financing challenge. So BWB was set up by Angus Forbes and Rubesh Madlani around a decade ago, after a conversation that Angus and I had actually around when I was seconded by Standard Chartered to work for the Prince of Wales, around we don't believe that it's the availability of money that's the problem, it's the conditions for that money to land is the problem. And what difference could it make if you created a not-for-profit investment banking vehicle that actually the talent was entirely dedicated towards innovating finance in that space? So that's the space that BWB occupied. We started off as a voluntary company organization for 6 years, and then in 2019 we actually decided this was quite serious and got a contract with the European Union. And at that time, there was 4 of us and 1 client. And now we have 40 full-time staff. We have around 60 more in the ecosystem within sovereign finance, within urban finance, across multiple sectors, of which nature is one. My colleague, Heather Matson, was due to be speaking on this panel, but you have me because Heather, COVID is back. It's a thing. So Heather was knocked over by that. But so going back to what BWB is all about is innovating new markets. And I think there's a lot of opportunity here. So if you talk first of all, just to quickly talk about the nature markets, and I know we're keeping this brief. Secondly, how we need to look more broadly and innovating financial instruments at a range of products to develop that nature market that I've referred to. And I guess nature as an asset class, of which, you know, the work that Slav and 10K and others are doing in this space, innovating. And thirdly, I guess, as you say, Gaurav, to look at some of those transactions and approaches. So I'm not sure if any of you know Simon Zadek of Nature Finance, but he has this phrase about 100% of the economy is 100% dependent on nature, but we're not valuing or recognizing that nature as an economic activity. I fundamentally agree with Simon on it. We are pricing a bit of it in the economy via policies and markets, but not entirely. Nature markets, where nature-specific revenues are generated, or an integral part of the trade, as an even smaller subset. And actually, if we really look at nature-positive, equitable nature markets, that are designed to achieve nature positive and equitable outcomes, that's an even smaller subset. So we have to do more. So and we need to innovate in that space. So in short, nature's undervalued, it's overexploited, and a lot of that is due to market failures. And those market failures occur when the markets don't accurately reflect the value of those resources. So in the case of nature, it's essential role in economic activity, and that activity is often overlooked, as I've said, and it results in significant negative externalities, which are not usually captured by the market. So we need to look more deeply. If I look at what some of the work that is going on, clearly, and actually 10K referred, I think, to that study by the EIB, we were actually part of that study a couple of years ago, and all around that, promoting the pipeline of nature-based solutions and nature-based investing in the market. In Europe, we did that study for the EIB. One of the major findings of that work is that this whole market is massively funded by the philanthropic and grant-based market. We need to innovate transactions that allow you to leverage in private finance into the space. The public finance is by definition, and philanthropic finance is by definition, difficult to scale. You're then going into nature-specific biodiversity credits, which have a better ability to scale. Payments for ecosystem services are perhaps slightly better. And then into this linked bonds and thematic bonds, where if we really create traction and teeth around the instruments, and I'll talk about that in a bit, we have a much more greater potential to enter growth at scale in these markets. The role of parametric insurance that we're working on. I was at a conference the other day run by UNCCD on the launch of a sustainable land management index, which is a parametric insurance type product. Slav, I know in the Belize bond instrument that you guys put out there, the parametric insurance that Willis Towers Watson is a great example of trying to mitigate some of the underlying risks in that transaction. We're seeing more and more of that type of activity coming to bear. I think that transaction was a real market leader, and it created some real waves, and lots of others followed from it. So we were really pleased to see that. And then into the nature biodiversity enhanced carbon credit markets, and into fund structures that actually invest at an enterprise level in nature related assets. And I'll talk about that in a second. So onto the market more broadly, there are limitations within the sovereign world, and also in the debt swaps world, as we've talked about. They're politically sensitive. You know, the transactions can go away and also be very subject to political stability. And I think they're a hugely valuable part of this, the ecosystem. But we need to look at more about how we innovate that. So just a couple of examples, and I'll pause. If you look within the fund investing world, actually this is something that Gaurav and the UNDP Biofin team asked us to look at. You know, a year and a half ago, we had a conversation that said, let's look at the Rhino bond structure, which was a great outcome. You know, it's a great project, but it took time to come about. And what if we could create a fund structure that not only was targeted at conservation of nature, but the principal, i.e. the main component of the capital, was directed towards the conservation element, rather than in the Rhino bond, it's just a small skim of the interest payment. So we launched in Bhutan a few weeks ago, called the Tiger Landscapes Investment Fund, which is investing in enterprise level transactions that support the outcome of tiger landscapes through actually investing in economically viable projects in various forms. It will be a blended finance structure, similar to the likes of the LDN or the Global Coral Reefs Fund, but actually financially modeled. So really important so that it can be scaled and replicated. I think that we're also working on a drought resilience fund, which builds on the Tiger Landscapes Fund, which is focused on actually enterprise level, which have a real nature-related outcome that build drought resilience at an economic level locally by investing in sectors that have that outcome. I think in all of these, whether it be thematic bonds, whether it be linked bonds, there is the need to deploy guarantees in those structures in a highly effective way, not least to promote to get the best pricing for countries. If you are an LDC, a lesser developed country, you're highly sensitive to pricing of those instruments, and therefore putting in place the right forms of guarantees into those structures is a real need to make those transactions happen more. And lastly, I'll look at the role of outcome funding, so outcome-based transactions. And we're working on this in a number of countries around the world. How can we enhance within the thematic bond, the linked bond world, the premiums that countries get from embarking on a sustainability-linked bond, so they get more value than the simple 25 basis points that the market has settled on, which is 0.25%. So can we combine pools of capital to further enhance those coupons to make them a more appealing concept? And the last one I'd add to it, what if, and this is something we're working on one country, what if we actually combine the best attributes of a sustainability linked bond with a thematic bond, where actually it was only forgive the technicalities, but a thematic bond, you can use the proceeds in a defined area. For a linked bond, it's general purpose, i.e. you can use it for whatever, and it's only the coupon associated with the achievement of the target. What if we combine those together and actually made a significant proportion of the capital actually use of proceeds in a linked bond? What difference would that make to actually really making sure that the bond is going to achieve what we want it to achieve? So in summary, there's lots of opportunity. I go back to the main points of what BWB is all about. There is money out there. We just have to deploy the right tools, the right mechanisms to make that money get to the place that we need it to be most and rapidly. I'll pause there.
Many thanks, Chris. A lot of insights there. So let me ask one question to each of the panelists, and then we'll open for Q&A. So since we have Tenke and Chris, I will ask you both one single question, actually two questions, and you both can answer on SLBs. And I'm also reading some of the comments and questions that are coming in the chat. And one of the really important question is on how do we integrate the ecosystem services and natural capital into the debt capital market. And this is where also the foundation of the sustainability linked bond was to accurately reflect the natural capital of the country, which is important for a country's economy, into the credit rating of the country. So in practical terms, we have seen the KPIs in the SLBs to be focused more towards NDCs and climate. So in practical terms, what are really the key challenges when you work with the countries, when you work with the corporates you face in integrating nature more into the SLB framework? So that's the first question. And the second question is more around how do we address some of the questions around transparency and governance, given that there is limited visibility on how the proceeds are used in the sustainability linked bond. So Tenke, perhaps you can go first.
Sure. So I'll give a short answer to both and turn it over to Chris, who I know has deep expertise here as well. The case study I wanted to do was actually on Brazilian pulp and paper company called Kleben in my English, but it probably has a nicer name in Portuguese. But they're one of the few case studies that have issued a sustainability-linked bond really tied to nature and biodiversity. So the triggers are I'm just pulling them up right now. One is water consumption. Okay, so not very exciting, but still with nature-based attributes if you look at the fine print. And then the other one was on reintroducing species that are proven to be extinct in certain habitats in Brazil, and promoting the protection, the reinforcement of other threatened species. So you talked also about the governance and this says I'm speaking a different language. I hope the translation's fine. This says I'm speaking French, which I should be, but I'm not, just to flag that. These instruments have been underutilized for nature, but indeed you can build key performance indicators that are nature-based. And I talked about materiality. I think the reason that these have been underutilized is because setting nature-based targets are difficult and they may be expensive to implement. And companies are unfortunately not incentivized to go above and beyond their day-to-day financially. But that said, with this KPI structure, they can set the coupons in such a way that they are rewarded potentially for overperformance. That was actually one of the ideas in the Rhino bond structure originally. And they are penalized for low or for poor performance. So the issue, however, as well with SLBs is that, as Chris mentioned, because it's a general use of proceeds bond, at the end of the day, you can be spending your money on other attributes. And it's why big fixed income investors like Nuveen have taken a position that we're not going to invest in these instruments, but hopefully they come back to the market when they see the nature points of view. And then on the governance and transparency, I think it's very important to work with a third party on monitoring those KPIs. Of course, I can speak for UNDP's work in Uruguay and others, because having this independent third party looking at the key performance indicators, monitoring, reporting on them, sends again a very positive signal to the market on the achievement of those targets or not. And it comes ultimately down to transparency and how much investors believe that you're going to deliver what you say you will. Maybe Chris, over to you.
you took most of it, 10K. That's a really interesting point. I actually wrote down transparency and governance and strategic relevance on my piece of paper here. When governments look to put the frameworks in place needed to issue these bonds, be it the so-called the bond frameworks governed by the international capital markets, it's really important in those frameworks that they identify themes which are strategically relevant to their NDC, their national priorities. You get a lot of competing interests in that work, and I think the rise in the accusations of greenwashing has even heightened the attention and scrutiny at a country level as to what themes and use of proceeds they put into these instruments. So I think nature is competing alongside greenhouse gas emissions, human development. So I think it's all about prioritizing those activities which are the most meaningful in the local context, if you are to avoid the accusations that your frameworks are not aligned with national interest. I think that's a balancing act we have to in the work. We've worked with over 30 countries producing this type of work, and it comes up every single time. I think when it comes to linked bonds, this is a really interesting one. We are very much an advocate that we need to balance nature-related outcomes at sovereign bonds with the more obvious climate change, greenhouse gas emissions, because go back to my first point, countries are entirely dependent on nature for their economies. So therefore, by definition, you have an attribute which is highly aligned to economic growth and economic stability. So we always very strongly advocate for these in our work. We just finished a bond framework for an Asian country where protection of forests and natural landscapes will be one of the two key performance indicators that will come out in that work, which we were absolutely delighted about, given the national context. So I think it's a balance of priority versus transparency versus investor integrity, and maintaining that balance as you go to issue these bonds, given the increasing scrutiny from investors in the space.
Thanks, Chris. Thanks, Danka. That was very helpful, very insightful. So Slav, question to you. The so we basically covered the commercial debt, um, the restructuring of the commercial debt, and the transactions that TNC has helped execute have primarily leverage credit enhancement through, for example, DFC, and in one case, I think IDB was also involved. Do you see more interest from other bilateral and multilateral institutions, particularly also now that sort of the some of the emerging lenders uh, are not the Paris Club members, but I guess that's more of a bilateral debt swap. So from the commercial debt perspective, are there any bilateral and multilateral financial institutions that you see would have more interest in such kind of transactions in the future?
Yeah, absolutely. We're super grateful to DFC and IDB for helping us pioneer the genre. And now we're seeing keen interest by the other regional development banks, by the African Development Bank, Asian Development Bank, also the European Investment Bank, and hopefully one day MIGA, the newly kind of booted up and expanded unit of the World Bank that is now also taking over the former guarantee operations of the International Bank for Reconstruction and Development. Many of these players, including others such as the French AFD, are members now of a task force, which was announced in Dubai at the COP, a task force of MDBs to coordinate their efforts in support of debt conversions and other sovereign-linked sustainability issuances. The issue of credit enhancements more broadly is absolutely paramount. I think a lot of the speakers talked about the challenges of placing these bonds and generating savings, because if you're just relying on greenium, so-called greenium, and I think that was Chris's point, that's very elusive. As elusive as a unicorn or perhaps an extinct species. And so what you need is a radical, credit transformation, especially for countries that are currently shut out from the international capital markets, which unfortunately characterizes most of the global South. The few examples of use of proceeds and even SLBs to Tenke's point that have been issued without credit enhancements have been issued by countries, by the few emerging markets that actually have investment grade or close to investment grade rating. The Chiles of the world, the Uruguays of the world, the Chinas of the world. Unfortunately, those characterize a thin sliver of emerging markets. And unfortunately, the vast majority are, as I said, are either shut out or have to pay through the nose more than 10% interest to fund themselves. And so therefore, you need something that changes the equation, and that something can be the clever limited use of public sector instruments to de-risk the transaction, take away some of the risks that private investors are unwilling or unable to price efficiently, and then unlock these large-scale capital issuances.
Slav, and if I could ask another question to you. So in the last few years, the debt profile has changed quite a lot. We have new emerging lenders that are not the members of Paris Club. And of course, this is outside the scope of the commercial debt swap that you talked about. So would you be able to share some of your views in terms of how the landscape around debt for nature swap is likely to evolve in the coming years?
It's a great question, and I think you're not naming names, but China, looms large. There are other South creditors that are quite prominent. India comes to mind, Turkey, and a few others. And look, the reality is, right, that in addition to the very large commercial debt pile, the latest World Bank estimates is that the global South has about 2 trillion or so of commercial debt, mostly Eurobonds, also some syndicated loans. There is an equivalent pile still of official debt. Some of it, really you cannot touch because it's provided by lenders of last resort, like the World Bank and the IMF. There is a shrinking, as you suggested, on a relative basis pile of official development assistance from the traditional kind of North and West, Europe, Japan, etc., and then a growing slice of, as you suggested, new sovereign lenders. And in many instances, to be perfectly blunt, if you take just China, in many instances, a lot of the Chinese loans to the global South are really unrecoverable. And the solution that the Chinese government has used historically has been to extend maturities, basically to kick kind of the can down the road and hope that by providing these liquidity breaks, things will work themselves out. Well, in some instances, you have a solvency issue, right? In addition to a liquidity issue. And that was the situation in Zambia, of course, which had to go through a painful default and restructuring. Sri Lanka, of course, Ghana, the examples are unfortunately way too many. And so then, the insight, let's go back to the 80s, right? A great era for pop, if not for hairstyles. Going back to the 80s, the insight of government to government swaps is still very much relevant, right? And if some of these creditors, whether traditional or non-traditional, these distinctions are semantics, want to recognize, right, that there is a global good out there, global biodiversity, global climate, and so if they want to deploy some of these tools, in a new way, imagine them in a new way, improve on the examples from the 80s and 90s, and offer these deals, right, to the global South, where they write down some of their claims that are unsustainable in exchange for credible commitments towards biodiversity and climate. I think a lot of good can happen out of that. Ultimately, it will be a political decision in Beijing, in Istanbul, in Washington, in Brussels.
Many thanks, Lau. So we will move on to the public Q&A. Mr. Nonde, we received a lot of questions from public to you, so I think it's best that I don't ask you additional questions. So let me pass on the question that we received from the audience to you. So the first question that we have received is around the green bonds, and what we have seen is when it comes to the proceeds of the green bonds, they are usually invested into technology, into sustainable infrastructure. But there are, of course, challenges in terms of investing them into the protection of coastal, marine, basically the nature, protection and restoration of natural ecosystems. And the main challenge is because of the lack of business cases, because of the lack of the ability to generate revenue in several cases. So how, in the case of Zambia, do you think that challenge could be addressed? Do you see opportunities around quantifying and creating a market for ecosystem services, such as carbon, such as water, biodiversity, etc.?
Okay, sorry. Thank you for that question. And I think we're still trying to also find solutions to that very question. So if you went through my slides, one of the initiatives that we are looking at is the revenue bonds by our local municipalities. And for a lot of them, we are still pretty much following an SPV model, and then you ring fence some revenue line. So for the CEC case that I talked about, they were able to ring fence the project cash flows, and therefore then you have some guarantee in terms of meeting the continuing obligations. For the revenue bonds one, it's slightly different because we are talking about subnational governments trying to find a way of avoiding a sovereign guarantee, because the messaging from the government is we are not able to give sovereign guarantees, because that's what ideally investors would be demanding if a municipal were to issue a municipal bond. So we're also grappling with that to say, how do we create some other facility or how do we ring-fence some other revenue lines or sources of income? And interestingly, someone actually brought up the issue of, for example, what happened during HIPIC. I don't know if people in the room remember HIPIC. Yeah, where the savings from debt relief were actually directed towards specific infrastructure projects. So it's a similar kind of model that we are also exploring in Zambia, where the government has released certain funds which are called constituency development funds. So that's funding from the central government to the local government. So that's one avenue that we're trying to guarantee. And that is before we even get to the nature question, because if you look at Zambia, really, we are still struggling with a lot of issues. Mm-hmm. So we haven't really begun to have the nature discussion, unfortunately, as at now. I think a lot of the conversations right now are around climate. It's only when you visit, for example, the CEC plant, and then you've got colleagues from WWF then saying, so what happened to the trees? What happened to that? That's when you sort of see nature creeping in. Thanks.
Thank you, Mr. Nonde. So my next question is not targeted to any specific participant. The question is from Carolina Peterson. She asked, thank you, but the others are welcome to join. And the question is around the wildlife species conservation bonds. I guess it refers to the rhino bond transaction or also the wild dogs transactions that is currently being designed in South Africa. And I guess you are aware of the structure, the financial structure of the rhino bond. So I guess the question is, are these really bonds where the proceeds are not specifically used for wildlife conservation? They are used for general sustainable development goals, but the difference in the yield that you get in terms of what you generate from the projects and what you pay to the investors is used for wildlife conservation. So any insights from Tanke or from any other panelist?
Really quickly, so I was indeed the first financial advisor on this transaction after I had left UBS, worked on this many, many years ago. And what Chris had said is that indeed it was really long-winded and expensive to produce. And the criticism, again, very publicly, is that very little of those potential savings actually accrued to rhinoceros at the end of the day. Yes, I agree with this criticism. I would say that the genesis of that instrument, the idea was to make it financially sustainable, to use ecotourism revenues to make it work. And it just didn't. I think we had looked at applying what is the value, so the trophic value, so to speak, of a rhinoceros, and it's not contributing anything. I mean, it's eating grass, and it's not like a wolf that can eat the deer, that can prevent the farmers from losing their crops. So really interesting intellectually to solve. I think going forward with species like wild dogs or others, I mean, fundamentally, it still is channeling financing to conservation, to species that otherwise don't have it. It's purely grant funded otherwise. So the innovations make sense, but I think the learning is now how to do the structure more efficiently, effectively, and hopefully more scalably. But I know that some of you have also worked on it since, so happy to turn it over.
Chris, anything to add?
100%. I think as Tenke said, the attributes of what the Rhino Bond designed to achieve are absolutely spot on. But it's new flows of money to rhino conservation that didn't otherwise happen, and I think it actually created some interesting moves in the market as to what could be done. If I go back to what you asked us as BWB to do, we first of all, if you remember, we started talking about a tiger bond, right? But then actually that structure iterates, because actually if you were to create a fund, without getting into banking technicalities, you don't need an issuer in a fund, whereas in a bond, you need someone to be the issuer, and that creates a completely different set of structuring challenges. So I think the idea of actually innovating that Rhino bond structure into a funding structure where you are therefore able to deploy that money into economically viable assets at a fund level, perhaps even multi-jurisdictionally, multiple country level, you have the ability to create change at a landscape level by investing in those different enterprises in that landscape level. In the case of the tiger bonds, the big thing is you invest in the landscape and therefore economic activities in that landscape, ecotourism, agri, forestry, ecotourism, etc. The benefit that creates the tiger landscape, which they can thrive in. You don't invest in tigers, you invest in much bigger than that. So, but the conservation outcome sticks. I think you can replicate that in multiple landscapes with multiple nature-based outcomes if you can get the structure to work. So I think the key is bankers love to innovate and replicate and trying to build on something which they can touch and feel. And in that case, the Rhino bond was super helpful because to allow us to build from it. Yeah.
Can I also chime in quickly? So it's interesting. There's a kind of a funny comment in chat as well on this. People seem to respond well to iconic species. And that's perhaps one of the reasons why there has been this focus on iconic species, on big five and apex predators. Incidentally, as an interesting NGO aside, I'm so jealous that WWF has the panda as their logo. That must have contributed, probably hundreds of millions of dollars towards their fundraising compared to the kind of the modest oak leaf, which is the TNC logo. But joking aside, I think that a couple of things. One, TNC focuses on durable, equitable conservation across landscapes that would capture, of course, iconic species, but also grasslands and tropical forests, the ecosystem at large. Second point is that the Rhino bond and others like it are examples of something that is called payment for performance type instruments. My biggest issue, and this goes to Chris's point, my biggest issue with payment for performance as conceptualized to date has been that it relies on bespoke fundraising, philanthropic style fundraising to actually create the pot of money that would be used to pay for the issuer for achieving these results. And that is very difficult and expensive and convoluted to do issuance by issuance. That's why I like Chris's idea of a fund, which would support multiple issuances where these essentially philanthropic funding to pay for performance is pre-committed so that bankers and sponsors don't have to raise it on an issuance by issuance basis.
Many thanks, Love. This is very insightful, and Chris and I had a series of discussions about it. We actually spent quite some time discussing about it, how we can take some of the lessons learned and move forward. All right, so we are at the end of the session. That went actually very fast. To the participants, you will shortly receive a brief survey. It will take you less than 1 minute, and we would appreciate your feedback. So in future, we are able to continue to deliver high quality webinars. And I want to thank you all, representatives from the government, from private sector, country offices, and other stakeholders for your time. Before concluding this meeting, I would like to express my thanks to the Global Environment Facility for providing the funds for this project and all the partners for all the joint work in this GEF projects. Many thanks again to our presenters. For further discussion, you can see presenters' email on your screen. And we have already checked with the presenters, and you are welcome to reach out to them bilaterally. You can find all the session recordings, presentations, and Q&A documents on the webinar webpage. My colleague is dropping the link in the chat now. My colleague will also share the link to the NBSAP forum webpage to explore the past webinar sessions. Please do not forget to complete the survey that I mentioned. We would really appreciate it. We look forward to seeing you in the next edition of the Public-Private Community of Practice for Nature and Development Finance, facilitated by UNDP Biofin and UNEP-FI. Many thank you. Goodbye.
Thank you. Goodbye.
Thank you. Goodbye.
we are good to start.